Given that April is Financial Literacy Month, we have decided to reach out to Luthando Mzilikazi from 91 to gain insights on how to manage your personal finances. Besides being a sales manager at 91, Luthando is also a certified financial planner charter holder, and she is currently busy with her master's degree in investment management at UCT. Hello, Luthando.
Hi, Antoinette. Looking forward to the conversation today with everyone watching.
We're looking forward to learning from you. Luthando, can you please share with us your top 5 tips on how to manage your own personal finances?
Happy to. I think just before we start off the conversation, I just wanted to give a slight disclaimer, and that being, this journey is for everyone. So we sort of, in this conversation, particularly focusing on people who are young at investing. So people who are starting to invest for the first time and are really trying to take charge of their financial future for the first time. But as the years go along and you become more astute at investments, there are different kinds of products that you can start rolling into the conversation. When you get married, when you build your family, those also have their own sort of top 5 tips. So today it's just specifically for people who are starting off in their financial journey. With that disclaimer out of the way, the first tip that I would share is one about budgeting. Yes, budgeting. No one really likes to talk about budgeting because it's a very rude way of reminding you where you are overspending and where you are actually running short. But for today's purposes, because we're talking about investing, the particular questions that I generally get around budgeting is lots of young people and people starting out like to say, I don't actually have enough money to start investing. So how do I do this? And a lot of those people say that because they don't budget. So let's get a mirror in front of us by setting a budget, planning our finances, looking at the income, looking where we're spending. And there is a theoretical principle around what is an optimal budget, right? So what are you earning and what are you spending your money on? So it's called the 50-30-20 principle. So 50% of your income should actually be going to essential expenses. So like paying your rent, your cell phone bill, your car, etc. So things you cannot avoid. And then 30% can actually go to your wants. So this is where you actually have some time to reward yourself today, where you can spend on restauranting or actually going on travels and going out with your friends, etc., or going on a shopping spree, right? So that all goes into that 30% and no more. Then the last 20% goes to investing into yourself for the future. And that's your saving/investments bucket. So 20% of your monthly income should be going towards investment. And that actually rolls over to tip number 2. So tip number 2 speaks to setting long and short-term goals around your money, right? So if you think about your broader life, whether it's about your profession or whether it's about your relationship, you set goals at the start of the year. So if you don't do this for your finances, you're not attracting positivity around your finances from the universe. So let's set goals. Like I said, they split into 2, long-term and short-term. Short-term goals are anything that you want to achieve within the first year of your starting your investment journey. And then longer-term goals are goals that take time. So they sort of span over a multitude of years in its investment horizon. I'll explain further in point 3 and tip 4. So rolling over to tip number 3 is, what exactly do I mean about a short-term goal? What does that actually look like? And what has that got to do with investing? So a short-term goal, like I said earlier, is a goal that you need to achieve within the first year of your investment life. So 2 examples that I can think of that I think are quite critical. The first being a rainy day account. So Antoinette, we all know that life absolutely happens. You either get retrenched or COVID hits, or your geyser bursts. There's so many things that can actually happen that really impair your ability to earn an income and therefore service your liabilities. So the rainy day account is essentially 3 months worth of your monthly salary saved up for an emergency. So guys, you deciding to travel with your friends, or you deciding to go on a shopping spree because you've gained a bit of weight, or the weather has changed, is not an emergency. So that rainy day account is something that you keep for real emergencies in case you need it. Trust me, you'll thank me once you have it and you've kept it there for real emergencies. Then the other example of a short-term goal could be saving towards a trip, right? So you and your girlies have decided that in 3 months' time you want to go away. I don't know, maybe to Mpumalanga, or you want to take an international trip. You can definitely set up a debit order with an investment platform to actually passively invest into that account over time, and then watch how it actually grows. So what's nice about setting up debit orders is that you don't physically have to go into your banking app and actually send an EFT, because that's kind of painful if that's not money you're going to use today. So a debit order is something you don't see, and what you don't see, you don't care about, right? So let's not care about the money that goes into that 20% of your income into the short-term savings bucket. So let's just set up a debit order and let that run by itself. And I mean, short-term goals can be anything, guys. It can be you saving up towards paying a cell phone cash instead of taking up a contract. So anything that you're going to need within a year's time, have an investment account for that, and then let the debit order run. The same goes for the rainy day account. So the rainy day account, once you actually get to that 3 months worth of salary, you can actually focus on another short-term goal and redirect those funds. You can set it up as 2 separate accounts if you're really lacking discipline like me. But if you're really disciplined and you can actually work out the splits, happy that you actually do it in one investment discretionary account. That gets us to point or tip number 4, which is a conversation around long-term goals. So guys, this is the goals that actually spans over multiple periods of years. And one big example that I think is absolutely important for everyone, whether you're an entrepreneur, whether you're employed, but I think it's specifically for whether when you are an entrepreneur or a digital nomad, because they typically don't have a retirement vehicle that they're saving towards as a condition of employment. So this means that you actively need to go and set up a retirement fund with an investment platform and save towards that every month. Now, there's 2 important things that I wanted to touch on as to why I say this is the most important long-term goal. The first is, obviously, you want to invest into yourself for your future self. So into retirement, this is your savings pool that you'd actually be drawing an income from. During your working career, let's say you start allocating money into your retirement account from when you start working at 20 years old, and let's say you work until you're 65. That's 480 paychecks saving up towards your retirement. And if you retire at 65 and live up to 100, that's 420 paychecks. And so if you're not saving a huge chunk of your income while you still can, before you buy that big house, before you have a growing family, before you buy the fancy cars, if you're not saving a lot towards your retirement, you're actually not rewarding yourself in the future, right, into your retirement. So save as much as you can in that 480 paychecks so that you can live your best life in that 420 paychecks into retirement. Notwithstanding the tax benefits of actually investing in a retirement vehicle. So if you really want a tax man to pay you back for you over contributing towards your retirement fund, you may want to actually start a retirement fund so that the tax man can actually pay you back. The 5th top tip that I've got for you guys speaks to you having a clear bill of health. Now, what do I mean about that? We're talking about investments, now I'm talking about health. So the first 4 points were about budgeting and largely about investing into an investment vehicle. Now I want to talk about policy. Yes, guys, policies aren't all bad. There are some that actually will work in your favor should anything happen to your health. So the first is having a life policy. So with life policies, there's some really cool structures that are offered by some service providers that can pay you a dread disease cover. So when you actually are diagnosed with a dread disease, they'll pay you out. So it's not necessarily for the day that you actually die, but also for burnout or when you've actually got, when you've been in hospital for 3 days. You know, some of them actually pay you a salary for as long as you're at hospital in case you actually need to be fully able to work to actually earn an income. So those options are out there for you. Not having a life policy is so old century. Second life policy, or policy rather, that I think you should have is medical aid. Yes, it's expensive. We all cry and moan about how expensive having a medical cover actually is, but it's actually a grudge purchase that's very, very necessary. You don't want to be in a medical emergency, like COVID as an example, and not actually have medical cover. That rainy day account in a short-term goal is not one of the emergencies that you should be actually taking from that piggy box or from that account itself. Because there's already a vehicle that you can actually tap into to look after yourself medically. And so that rainy day account is not meant for that. Then lastly, if you are an entrepreneur and you're running a business or you own assets, you want to ensure that those assets are also covered. Because, for example, let's say you have a logistics company that you're running and your truck has now broken down. You could take from your rainy day account, but then you're depleting that account unnecessarily, because you could have just taken insurance on your trucks so that in anything that happens to them, you can actually quickly fix it without any financial pain, and then being able to restore your revenue to normality. So life policy with great benefits, medical aid, and your asset protection cover is also very important. So those top tips very quickly: budgeting, number 1, setting goals, number 2, short-term goals, number 3, long-term goals, retirement plan, number 4, and your clear bill of health is point 5.
Lou, thank you so much for these tips. But now my next question to you is, let's say I have decided to implement your advice and I've placed all of these tips into play: long-term, short-term, medical aid, life policy. What is next? If it has been done, do I leave it? What do you say is the next step?
I think the next step is, like all things in life, you want to review how well you're doing with respect to your financial goals, right? So I do think that not enough people have a view of what's actually happening in the investments, particularly the people who only are invested through a retirement structure because of a condition of employment, right? They never really look at how well their contributions are going or how well the investment is actually growing. But you actually need to look at these accounts on an annual basis. Let me break it down to you in a way that may be easier for you. So every year, quarter 1, in the first month, should be the month that you actually focus on looking at your retirement plan. So how is that growing? Is it growing well? Are there any changes that need to happen? And this is why doing it in January is actually important. February is the end of the tax year. And so if you ever actually wanted to add any contributions towards your retirement plan to get more tax breaks, you want to do it between January and February for the latest. So definitely January is the first review that you want to have in quarter 1 for your retirement plan. Quarter 2, naturally, then is your short-term investments review period. So again, in the first month of quarter 2, which is April, you can have a look at how well your rainy day account is actually going. And if it's going well, and now you've met your 3 months income cover, you can actually redirect those funds into something else. But if you actually aren't doing too well with the growth of your short-term goals, whether it be, to go on a spree or to go traveling with your friends or the rainy day account, you can then adjust your premiums or your debit order to actually match up with your financial needs, given how many months would be left. Then quarter 3, in the first month, you could then look at your bill of health. So does it still make sense for you to have this life cover, or have you actually purchased the house? Because then you can actually include the value of the house in your payout for your actual life cover. So those kinds of things make you actually, should trigger you to actually have a look at your bill of health and see that all 3 of those insurance covers are also still very much relevant to what you want and what you going forward. These do sound like a lot, and there are a lot for us in the industry as well, in our own personal capacities. You've got your profession that you need to look after, your relationship, your friendships, your family. There's a lot. So if you are needing assistance with all of these things and more, because trust me, there is a lot more. This is an oversimplified version of what it takes to build a financially successful life. Please, guys, do not fear. Reach out to an independent financial advisor. And I say independent quite critically, because you do have financial advisors that aren't independent and therefore will always sell you products from the house that they actually get a salary from. So you want to avoid those because you want to have as much independent advice as possible so that the advisor needs to then take into account your financial needs, your financial standing, and your investment horizon, and give you a few options of what would best suit you. And then on a buy-in basis, you then establish those products and platforms that you will then invest in and take on from an insurance point of view with an independent financial advisor. Make sure it's someone you can talk to and be honest to. The last thing you want is to pay someone for advice and you're not being honest with what your goals are, where you are standing. So let it be someone that you can have banter and be honest with so that you can have the best start to your financial future.
Thank you, Luthando. And just on that side, I would just like to jump in and say Delta 4 is a very proud independent brokerage. As you've mentioned, independence goes a long way just getting client buy-in, but from a broker perspective, it also means that you have the whole industry of products to compare to be able to give your client the best product out there for their specific needs. So thank you so much for highlighting that. And thank you for bringing all of these points to the table. This has been so informative.